Hi guys, this is Group C, and we're going to be talking about chapters 7 and 8. My name is Guy, and I'm here with Martin, Salina, Kyle, and Ryan. The topics we're going to cover include consumer loan basics, controlling debt and student loans, process of buying a vehicle, process of buying and renting a home, and getting the most out of your mortgage. Starting with chapter 7, a loan is a formal contract detailing how much you can borrow and when and how you are going to be paying that back. It's typically used for bigger purchases that can't be paid up necessarily up front. For example, buying a house, buying a car, opening a business, and so on. When taking out a loan, you have a couple options, such as single payments versus installments, secured versus unsecured, variable rate versus fixed, short versus long term. Single payment loans are paid back in a single lump sum payment with interest at maturity. So that means they're usually short term and cover less value. Versus installment loans, which they are repayments of principal and interest at various intervals. And this process of repaying a loan is called loan amortization. Secured versus unsecured. So you have a secured loan that is guaranteed by an asset, which typically lowers the interest rate because that makes it safer for the person lending the money. So, for example, if the borrower defaults, the lender secures collateral like car or house. And you also have the unsecured loan, which is not guaranteed by an asset or collateral, which makes it riskier and therefore the interest can be higher. Then you also have variable rate versus fixed rate. So the fixed interest stays fixed for the entire duration of the loan. So, for example, a 30-year fixed rate mortgage versus the variable adjusted loan, which the interest rate varies based on market interest rates. That can be affected by Fed fund rates, the secured overnight financing rate, prime rates, and so on. The prime rate is just the interest banks charge to their most creditworthy customers. And you also have convertible, which is a loan that's a variable rate loan that can be converted to fixed, depending on the contract. And then you also have maturity, which is short and long term. The short term lowers interest rates and has larger monthly payments. The long term has smaller monthly payments and higher interest rates. So an example of that would be a 30-year mortgage instead of a 15-year mortgage where you can pay less per month and instead invest the extra money. And an important thing to note is that the source of the loan actually can cause it to be more expensive or less. So a couple of inexpensive sources include family, home equity loans, cash value, life insurance loans, and so on. Slightly more expensive are credit unions and commercial banks, and the most expensive are retail stores, finance companies, or small loan companies. Moving on to special types of consumer loans, you have automobile loans, which are secured loans for purchasing vehicles. They usually go from 24, 36, or 48 months. We're going to be talking about that later. And then you also have home equity loan or second mortgage, which is a secured loan using equity in your home as collateral, also known as HELOC, home equity line of credit. A couple key features of a HELOC are that they are secured. So that means you're putting your home at risk. Revolving credit, so you can withdraw funds as needed rather than receiving a lump sum. Also variable interest rates, so that means it's risky because it's typically tied to prime rate, meaning that your payments can change over time. Drop period, and it has drop periods and repayment periods. So usually the drop period is around 5 to 10 years, and then the repayment period is around 10 to 20. And when is the best time to take in a HELOC is when you have enough equity in your home so that you can pay off your mortgage. This is what a HELOC problem looks like. What is the maximum amount Sarah can borrow through HELOC? And you have a whole story here that I'm going to summarize. So she made a 20% down payment, financed the rest of the mortgage. Current mortgage balance is $320,000. Home appreciated to 750. Maximum loan to value is 80%. To calculate the maximum loan amount, which is the first step, you take the loan to value, in this problem 80%, and you multiply it by the current new home value, which is 750,000, and you get $600,000. Then you calculate the HELOC available for Sarah, and you do that by taking the max loan amount, in this case, $600,000, and subtract the existing mortgage, $320,000 specified in the problem. So the answer for this problem would be $280,000. Other things that you should know is that APR stands for annual percentage rate, which is the simple percentage cost of all finance charges over the life of the loan on an annual basis. And also payday loans, which are short-term, high-cost loans that provide quick cash, usually $100 to $500 due in 1 or 2 weeks, with annualized interest rates of up to 400,000, which basically means you're voluntarily getting robbed, paying 400,000 or 400% interest. So you should only take that in case of emergencies. And then moving on to add-on loans, the definition is a loan where the interest calculated at the beginning and is added to the principal. So borrower pays total in equal installments. To repay early, that depends on the method to determine the amount of principal owned, which may change according to the contract. So for example, you have the rule of 78, which is a common method to determine what proportion of each payment goes towards the principal. That is red here in this problem used in the textbook. So that actually benefits the lender as interest heavy on the first few payments. If you look at the first one here compared to the reducing balance method in blue, in case of prepayment compared to the blue one. And then actually moving on here, I made a custom Excel sheet that you can download on this link, which I'm going to show right now and lets you play around with a scenario of a bet on loan calculation. The rule of 78 is a method used to calculate interest on short-term loans by front-loading the interest. So to do that, we the first step is to calculate the monthly payments. In this case, here we have 12 months interest of 3% and a $100,000 loan. Using these values, the monthly payment is going to be around $100, the formula on the top left. Step two is to calculate the total interest. We can do that by if we multiply the monthly payment by 12 and subtract the loan amount, which gives us around $205 in total interest. Then step three is to calculate interest for a specific month. Let's say you want to repay the loan by month 7. Then what you're going to do is using the following formula, 13 minus t, which is the period you're in this case 7, divided by 78 times the total interest that we just calculated. So for month 7, the interest payment is going to be $15. And step 4 is to calculate the remaining balance after month 7. And we do that, we subtract the principal paid from the previous balance, leaving $462. So taking that into account, the rule of 78 makes early payments more interest heavy, which benefits the lender if you plan on paying off the loan early.
Hi, everyone. So I'm going to be talking about keeping control of your debt levels, how you can pay off debt, and what happens when you can't pay off debt, as well as college student loans. So when it comes to keeping control of your debt, the amount of debt one should have is relying on multiple factors, but mainly age and your income level. So your proportion of debt to income has an inverse relationship with your age, right? As you get older, you make more money and you take on less debt. And we use the debt to limit ratio that should be around 15%. 20% is a hard ceiling, and that's calculated by taking your total monthly non-mortgage debt payments, which is what you see on the right-hand side, and dividing that by total monthly take-home pay, which is your net income. So consumer credit should be short-term, and it's also considered more expensive than mortgage payments, which is why we don't include mortgage payments into the debt to limit ratio. So when it comes to the ideal mortgage candidate, creditors tend to use the 28 to 36 rule. And that means that your mortgage to gross income ratio should be 28%, and your total debt payments, that's including consumer credit, to gross income should be around 36%. So the average mortgage payment in the state of Florida in 2024 was $2,443. If you do some reverse engineering on that using the ratios, the ideal monthly gross income by those standards is around $8,725, which is an annual salary of around $105,000. So what happens when you can't pay? So the best thing you can do is to not get in the situation, and what you have the most control over is budgeting. And so if you budget your money properly and manage your debts, then you won't have this problem. But if you do, the best thing you can do is to reach into your savings. You can reach out to creditors and use a debt consolidation loan, which pays off all your debts using one single loan. And then the last resort is to turn to bankruptcy court. So there's two types of bankruptcy. The first one we're going to be talking about is the Chapter 13. It's the wage earner plan. So the qualifications for this is that you need regular income and secured debts under, as of 2024, $1,184,200. Secured debts are debts backed by collateral, and unsecured debts are the opposite. They're not backed by anything, just around $395,000. So this is a process that typically lasts 3 to 5 years, and it's court supervised, and there's no repossession of your assets. There's essentially just a schedule and a plan put in place to repay whatever debts you can. So Chapter 7 is where there is a repossession of assets, a last resort plan, so to speak. So the means test is if your disposable income is lower than your qualified monthly expenses, that's when you would qualify for Chapter 7 bankruptcy. So here, most debts are wiped, except certain important debts such as child support, alimony, student loans, taxes. So in this process, trustee collects and sells all non-exempt property. Examples of non-exempt property are here on the sides. All right, so moving on to student loans and education. As of October 2024, the average student loan debt in Florida was just under $40,000, according to the Education Data Initiative. Student loans are something that affect almost everybody in a college classroom, specifically around 2/3 of all students have some sort of student loan debt. And it's important to understand the effects of your choice of school and your major when you go to college. And later on, when you get to college, how you're spending money on campus. It's important to leverage tools before taking on loans, such as federal aid, financial aid offered by the university, grants, scholarships, and tax credits. Right. So how can you pay for college early so you can minimize the amount of loans you have to take out? So you can do savings plans that provide tax benefits, federal tax benefits specifically, and a variety of investment plans. You have the 529 saving plan and the 529 prepaid tuition plan. As long as a Coverdell education savings account, you can also get federal student loans, which are offered at a fixed interest rate. And if that's not enough to cover the cost of going to college, you can get private loans, which tend to be higher, more variable rates. So you've taken on loans and now it's time to repay these debts. You can set up a repayment plan for yourself, or there's other options such as deferment, which is available when you're at least part-time, unemployed, or you meet hardship standards, which allow you to postpone up to 3 years. No interest is accrued on subsidized loans. The same cannot be said for unsubsidized loans. And then there's also forbearance, which is delayed repayment. However, these still accrue interest.
Chapter 8, the home and automobile decision. Steps to smart buying. Step 1, differentiate wants from needs. Separate your wants from your needs. Make sure you can afford it and it won't interfere with your ability to pay for your needs. 72-hour purchase rule pause. Take 3 days to reflect on a purchase and buy it if it still makes sense after 3 days to eliminate impulse shopping. Step 2, do your homework. Determine your budget. Research product options, price ranges, and features. Look at ratings and reviews. Consumer Reports provides unbiased ratings and recommendations for products and services. The Consumer Action Handbook provides tips and information. Step 3, make your purchase. If it's a simple item, go to the store and buy it. If it's a more complex item, negotiate to get the best price possible and know the markup, which is how much price the dealer adds to how much they paid for the product. Step 4, maintain your purchase. Physical maintenance and resolving complaints and smart buying in action. Buying a vehicle. Step 1, differentiate your wants from your needs. Ask yourself these questions such as, do you need a car? Do you live in the city? Will you have somewhere to park it? Do you have a family? Do you do a lot of hauling? What is your lifestyle? Make a list of the features that you need versus the ones that you want. An average price for a new car in 2025 is $49,740 according to CarEdge, with the average price of a used car in 2025 of $25,721 according to CarEdge. Step 2, do your homework. Determine whether you want to lease or buy. Determine what kind of car and how much you can afford. It must fit into your budget. How much is your down payment? How much can you pay each month? Find a car that suits your budget. Then find a bank or credit union to ask about auto loan rates. Installment loans are monthly payments. Say you want to take out a 3-year or 36-month installment loan for $20,000 at 10% annually. Your monthly payment would be $645.34 for 36 months. Consider a used vehicle. The pros include cost less, it's lower down payment, and it depreciates lower than a new vehicle. Cons include more mechanical issues and it may not be under warranty. What features do you want? Go to dealerships and test drive different cars. Consider operating and insurance costs. Used cars have more operating costs. For example, a Mercedes has higher insurance costs of $3,000 compared to a Ford at $1,000, depending on the state that you live in. Step 3, make your purchase. Fair prices can be found on Edmunds.com. Factory price is how much the dealer paid for the car. The dealers receive a holdback from manufacturers when cars are sold. A holdback is when dealers receive around 2 to 3% of the sticker price of the vehicle from the manufacturer when a car is sold. For example, a new Ford Explorer has a sticker price of $35,000 and the dealer invoice price was $32,900, so the markup would be 6%. If the dealer sold that Ford Explorer, the dealer receives a holdback from the manufacturer, which would be 3% of the sticker price, so it would be $1,050. So the markup would actually end up being 8.7379%. See if a manufacturer is offering rebates on carsdirect.com. If you're financing, compare different options from banks, credit unions, and dealerships. Take your time. Don't add things you don't need. Test drive. Don't be afraid to leave without buying. At the end of the month is the best time to buy because salespeople need to reach their targets. The amount you pay depends on demand and holdback. Consider different financing and buying options. Auto loans. The shorter the amount of time you borrow, the higher your monthly payments will be. If you borrow $20,000 at 4.5% for 24 months, your monthly payment is $872.96. If you borrow for 48 months, your monthly payment becomes $456.07. Cash is the cheapest option where you pay full price for the vehicle upfront. Leasing is ideal for individuals who are financially stable, want a new vehicle every few years, drive less than 15,000 miles annually, and want hassle-free trade-in and maintenance options. Leasing options, a close end or walk away, is where you return the vehicle at the end of the lease and walk away from future responsibilities. You bring the vehicle back in good condition with normal wear and tear, and the dealer is responsible for reselling. An open end is where at the end of the lease, the current market value is compared to the residual value. If the vehicle is worth less than originally estimated, you pay the difference, which is not the best option. A purchase option is where you buy a vehicle at the end of the lease for residual or fixed value as it's stated in the lease. A closed open-end lease is determined by how much the vehicle is expected to depreciate while you have it. If you take out a 2-year lease on a car worth $25,000 and it's expected to drop $16,000 in value in 2 years, you will pay the difference, which is the depreciation charge and finance charges. The lease is based on the price agreed on, upfront fees, insurance, taxes, down payment and trade-in, the value of the vehicle at the end of the lease, rent or finance charges, and the length of the lease. The rent charge is the finance charge built into the lease, and it's like the total interest. Keys to a good lease include good price, warranty that defines normal wear and tear and covers entire lease for all major repairs, a low down payment, a termination fee for ending the lease early, and the depreciation factor, which is the payment based on what the vehicle is worth after the lease. So you might pay less on an expensive car that depreciates slower. Step 4, maintain your purchase. This includes regular maintenance, paying attention to your car when you drive it for unusual sounds or leaks, and the warranty provides coverage for basic parts, corrosion, engine, transmission, and powertrain for a set amount of time or miles, depending on the car. Lemon laws are state laws to protect consumers when they buy a new vehicle and it fails to function like it should. You should try to fix the issue 3 or 4 times depending on the state, and settlement is equal to the purchase price adjusted for usage. Housing. Housing costs can take up to over 25% of after-tax income. It's a big investment and it's based on your lifestyle, your wants, needs, and your budget. A house offers privacy and space. You can have greater control in the style, decoration, and home improvement. The owner is responsible for maintenance, repair, and renovations. Cooperations and condominiums. A co-op is an apartment building or group of apartments that are owned by a corporation and residents are stockholders. Residents buy stock in a corporation, which gives them the right to live in the building. They don't own the unit, but they can occupy it as long as they hold the stock. They have a hard time getting a mortgage because banks don't like stocks as collateral. They have to pay monthly homeowners association fees to the corporation. This is good for low maintenance, affordability, and shared amenities. It doesn't offer much privacy or control. A condo is an apartment or apartment complex that allows for individual ownership of units, but joint ownership of land, common areas, and facilities. They pay for their own apartment, but they share amenities. It can vary from apartment or townhouse or office buildings or high rises. It's similar to a co-op, but have direct ownership of specific unit, not just shares in a corporation. Apartments or other rental housing. They are affordable, low maintenance, have little financial commitment, and can move around with minimum inconvenience. They're good for young and single people since when they start out, they might not have enough for a house or know where they want to live. It has limited upkeep, short-term commitment. However, it does have a lack of choice, and some you can have a pet or customize it.
My name's Kyle, and I'll be going over smart buying in action for housing and the advantages of buying versus renting. Step one is to differentiate your wants from needs. You need to know what about the house is so important. You also need to identify what you want before you even look, which could be affordability, location, neighborhood, conveniences, and schools. Step two is to do your own homework. You can go on Zillow and type in specific filters to find your perfect fit. You need to investigate the potential home and all that goes along with it, the neighborhood, community lifestyle, and anything that satisfies your overall needs. You also need to consider how much you can afford to pay without struggling the monthly mortgage payment. One-time costs include down payment, closing settlement costs, which include points or discount points, loan and origination fees, loan application fees, appraisal fees, and title search fees. Recurrent costs include monthly mortgage payments, the acronym PITI, which stands for principal, interest, taxes, and insurance. Other recurrent costs are maintenance and operating costs, which include repairs, renovations, upgrades, and landscaping. Renting versus buying. Renting, you have mobility, which gives you the ability to relocate without incurring real estate selling costs. No down payment required. May involve a lower monthly cash flow. You only pay rent, whereas homeowners pay mortgage, taxes, insurance, and upkeep. There are often extensive amenities, including pools, gyms, and health clubs. No home repair or maintenance, no groundskeeping, no property taxes, and you are immune to losses due to housing depreciation. With buying, it allows you to build equity over time. The possibility of property appreciation allows for a great deal of personal freedom to remodel, landscape, and relocate to suit your taste. There are significant tax advantages, including a deduction of interest and property taxes, no chance of rent rising over time, and your home is a potential source of cash in the form of home equity loans or home equity line of credits. Determining what you can afford. What is the maximum amount that a bank will lend me? Banks consider your financial history, your ability to pay, which is signified through your credit score, and the appraised home value. Should you borrow up to this maximum? The lower your debt to income ratio and the higher your credit score, the higher your maximum loan could be. Financing the purchase. Sources of mortgages include Savings and Loans Association and commercial banks, credit unions and mutual savings banks, mortgage bankers, which originate mortgage loans, sell to banks, pension funds, and insurance companies, therefore through they collect payments. Mortgage brokers are the middlemen comparison who shop for a fee to secure mortgage loans for borrowers who but not originate the loans. They just connect the loans with the buyers. Conventional and government-backed loans. Conventional loans are loans from a bank or savings and loans association secured through the property itself. Government-backed loans is a loan from a traditional lender but insured by government through Federal Housing Authority or Veterans Association loans, which have lower interest rates, smaller down payment, and less strict financial requirements. However, they have more paperwork, higher closing costs, and limited funding. Fixed rate mortgages are mortgages that have a monthly payment that does not change regardless of market interest rate changes. You can lock in low rates for the life of the loan, which is the best case scenario. An assumable loan can be transferred to a new buyer where the buyer takes over the mortgage from the seller. A prepayment privilege allows early cash payments to be applied to the principal, which lowers your overall cost. Adjustable rate mortgages are mortgages with interest rates that fluctuate with the level of current interest rates. The initial rate, or the teaser rate, is the low for only a short time period, then adjusted upward. The interest rate index are rates on adjustable rates that are tied to an index not controlled by the lender, such as a 6 or 12-month U.S. Treasury. The margin is the amount over the index rate that the adjustable rate is set. It is a fixed percentage added to the index rate, which is a key factor for determining the monthly payment. The adjustment interval is how frequently the rate can be reset, how often the rate can adjust based on the market index it's tied to. The interval is usually every 1, 3, or 5 years, depending on the index. The rate cap limits how much the interest rate can change or go up by. The payment cap sets a dollar amount limit on how much the monthly payment can increase during an adjustment period. If interest rates go up, the monthly payment may be too small to cover the interest due, which is negative amortization. Unpaid interest is added to the unpaid loan balance, increasing its overall size. A convertible arm to a fixed rate loan, which is where a borrower can convert to a fixed rate, typically after 5, 7, or 10 years. The reduction option and adjustable rate is a one-time opportunity to adjust the interest rate. When interest rates drop, the reduction option matches the borrower to the current mortgage rate, then becomes fixed for the remainder of the term. The two-step arm is a combination of both aspects. It is a mortgage with an introductory fixed rate for a set period of time, followed by an adjustable rate for the remainder of the loan. Overall, adjustable rates have lower interest rates in the early years, but can get high later on. They can get a larger loan because PITI is lower, and they reset interest rates, which push overall adjustable rate payments upward. On the other hand, fixed rate mortgages are better than adjustable rates. The payments never change, and it allows for overall control and planning.
So moving on to adjustable rate mortgages, or ARMs, these mortgages adjust their interest rates based on the market, which then affects your monthly payment amount. So for example, here we have a 7/1 ARM, which means for the first 7 years, the rate is fixed and then it adjusts annually thereafter. So initially with a principal of $400,500 at a 2.7% rate, you would get a payment of $1,635.01. And then after 7 years, this rate adjusts based on the 1-year LIBOR plus a margin, which leads to a new rate of 4.25% and a reduced payment of $1,297.15 on that remaining principal. So this example here illustrates how ARMs can change over time. So moving on to specialty mortgage loan options. If you're going to buy a house, you have a few examples here, like balloon payment mortgage loans, which offer small initial payments and a large final payment, which is good for those expecting a future income increase. Next, you have graduated payment mortgages, which start with low payments that can increase over time. So this could be suited for young professionals expecting a salary growth. Next, you have growing equity mortgages, which increase your equity quickly as payments rise over time. Next, shared appreciation mortgages, which offer below market interest rate in exchange for a share of the appreciated home value upon the sale. And next, you have interest-only mortgages, which allow you to pay only the interest for a period of time before paying the principal and interest, which can help manage your short-term expenses. Lastly, there's option payment ARMs, which provide multiple payment options, which can include minimum, interest-only, and full principal and interest payments. So there are some risks you should be aware of that are associated with specialty mortgages. One is payment shock, which can especially occur with ARMs or balloon mortgages. And these are when the rates reset or maybe the balloon payment is due. Next, you have complex terms. So it's crucial to understand all the loan terms to avoid negative outcomes, such as negative amortization. Lastly, you just have regular market risk. So rising interest rates can significantly impact your payments, especially in the case of ARMs. So you also want to beware of subprime mortgages and predatory lending, where they target low credit borrowers at higher rates and exploit those borrowers. So many of these practices include unnecessary high fees, bait and switch schemes, and loans based on the home's value rather than your ability to pay. And here on the right are some examples of common predatory mortgage lending practices. So here is a comparison of a 15 versus 30-year mortgage. Generally, 15-year mortgages offer less interest over time, but higher monthly payments, which leads to quicker equity buildup and requires more saving discipline. Next, we have a 30-year mortgage, and in comparison, they generally offer lower monthly payments, but it increases the total interest paid over the entire length of the mortgage, which also offers more cash flow flexibility. So when you're going to put a down payment on the house, typically you need at least 20% to avoid a private mortgage insurance or PMI, which can significantly increase your costs. PMI is required if you borrow more than 80% of the home's value, and that can range from 0.3% to 1.5% of the loan amount annually. So here, applying that knowledge from the last slide, let's slide into an example. We have here John, who's considering buying a $300,000 home. Based off his monthly income of $5,000, the 28% rule allows him $1,400 for housing expenses. With a $60,000 down payment, he is able to avoid PMI as when you look at the LTV here, he's able to keep the loan to value ratio at 80% exactly. So next, here is the general purchasing process of buying a house, where you begin the home search, then move into comparison shopping for homes. And there's a couple key steps here. Generally, a big one is selecting the real estate agent. So you have a couple different options you can go with there. You can go an independent agent or an exclusive broker buyer. Additionally, you want to get to the point where you can make an offer and negotiate. And then eventually that will lead to closing, where you finalize a purchase by signing the contract and completing the settlement. So now that you own a house, you want to be able to maintain that purchase. And that financially involves monitoring market rates for possible refinancing opportunities. So generally, if the rates fall by 2% or more, you can reduce costs over time despite the initial closing costs, and it might make sense to refinance. That being said, you want to be cautious. You want to be aware of possibly incurring closing costs again and evaluate if the long-term savings will justify the initial expense of refinancing.